Hi there, everyone. It's great to have Steve here today. We're going to talk a little bit about the environment that we're in at the moment. That's been more volatile, I guess, than we probably expected. What we'd like to do is talk to a little bit about what we're seeing in the market, how we are framing the environment, and how we're actually acting at a portfolio level, and what are our stocks doing within the portfolio. But I guess, Steve, what we're trying to get a sense of. Where have we come from? Where are we now? And where do you think we're going to? And I guess that's a good way to start. How are we thinking about markets going into the year, and what's really changed?
Yeah, sure. Well, there is lots to talk about because obviously conditions have changed a lot. But it's important, perhaps. Yeah, let's start with what conversation was happening only a few months ago about considerations for this year. We all spend time reflecting at the end of a calendar year and framing what may play out in the coming year. And perhaps at the start of this year, we were thinking about a range of matters, but particularly as it relates to what's happened, one of the questions we were asking was, is Trump a buy the rumour, sell the fact moment? And we've got a slide on that just showing how buoyant sentiment was in the market at the time. And the second was just wanting to take stock more broadly over a multi-year period of the sort of status of the US equity bull market cycle. So that they have a cyclical nature. Markets aren't devoid of going down. And our observation, as you know, which does feature in how we shaped the portfolio, was we were in an advanced stage of the bull market where we we have supportive earnings, but we have elevated valuations. So a euphoric phase communicating a need to be a bit more defensive and be quite selective heading into this year. Now, we didn't anticipate tariffs landing the way that they did. They've obviously landed in a far more draconian way than expected, but I think the point still stands. It's always worthwhile having a perspective about what the shape of a cycle looks like. We know bull markets don't die of age; it's more just exhaustion. So that's sort of the flavour and how things have changed. And I guess since that time, Will, and I'll ask a question to you shortly. The sell-off's been severe. There's been a significant correction. For example, the Nasdaq's just touching 20% down calendar year to date. Our market's down about 10. No sector's really been spared other than perhaps pockets of defensive areas of the market, staples, utilities, interest rate sensitives, and then obviously energy. And other areas have fallen. But again, if we were to step back, a question that I might ask you is, you and I have both been through these cycles before. What sort of indicators do you look for? Or how does it come through to you in how we should be thinking about investing?
Yeah, I mean, it's a great summary of what we've seen so far, and you're right. They usually there's a bit of a catalyst or a nudge to really push the market over the edge, but quite often there are indicators there waiting for a catalyst. So what we had at the start of the year was indications of a weakening US consumer. But again, then we look at a few other indicators across the board. And what we'll do today is Steve and I will talk. We have some charts that will be able to pop up within the feed. So bear with us as we go through this process. But the reality is markets do go down, and it hasn't felt like that for a long time. Sorry. Pullbacks or contractions or have become further apart as we've gone through time, and that's because monetary policy and stimulus, and so the Federal Reserve has been printing money and taken action to keep stability in the market. But here we are today, and volatility has come back, and it's always a different catalyst. We had COVID. We've got Trump and his tariffs, and there usually are indications or reasons for it along the time. But the reality is they all impact the markets and the economy in the same way. We need to look for indicators and evidence for which we react. So a lot of our time, we need to assess the understanding, and I have talked through these before. At Climb, we have a framework of thinking, key indicators we look for, and we aggregate those in growth, and that brings together economic growth and growth that we can see at the underlying company level, which comes across in the earnings per share of markets. Then we have an assessment of risk or financial conditions. How supportive is the environment? Can the Federal Reserve cut rates? Are they cutting rates? Have we got QE happening? What are credit spreads doing? These are really important indicators for understanding how much risk investors are willing to take on. Another part that's probably come into more our thinking is sentiment, and it's really important. It's become more important because we have the prevalence of super funds just buying into the market. We've got ETFs and this portfolio hedge fund key fund manager positioning, but also sentiment within markets. And what Steve alluded to or actually talked about was just the severity, the extension of global positioning in risk assets. And now there were reasons for that. We had US exceptionalism, we had Trump coming in place, and the idea was that he would deregulate and such, but now we're getting the other side of the coin. And I guess that all comes together and it's represented in valuation. So as I bring it together, growth has gone from expansionary to contractionary, and the tariffs itself there is a risk that does pull growth back more. Financial conditions has actually become more contractionary from expansionary. When we're going to look for catalysts, and a key one is when we see rate cuts and other ways in which more liquidity is pumped into the market as a key catalyst for us buying this dip. But financial conditions are getting more restrictives, and the US dollar is a key part of that too. Sentiment was extreme. It's actually going to the green now. We've seen an extraordinary repositioning in global portfolios. We're almost at extreme negative levels. Now, that does give us the ability to rebound off these levels, but we do need to see either a decreasing in risk or an improvement in growth. And where's valuation? We've gone from elevated levels, as we know. Now, there are reasons for that, productivity and such, but we can't fight history, and the valuations probably have a little bit more room to move back for us to have things flashing green. We're kind of orange at the moment. We were in red. And as we add all those pieces together, we get a framework for our thinking, and we'll continue to update you on that as we go. So that's a big picture, Steve. How do we translate that, or how are you thinking about these indicators and what we can do at the company level and the portfolio level? Is it important to understand how do we bring it to the table when we have our discussions? And then I guess we'll get to the stocks. And
yeah, that's a good segue.
Yeah.
So we have to obviously translate a complex high-level environment into individual stocks. And I think the point Will was sort of alluding to somewhat in that discussion there was that no sell-off is the same. It's always a different context. The context of this down market is tariff-flavoured, which we haven't seen in a generation plus. Previously, it's been either credit or we've had a pandemic. We have had a European crisis. And as John Abernethy would say, crisis is normal. For us, investing your money and thinking carefully about what stocks we have, one of the things to emphasise here is as much as the macro really matters, we're careful not to overemphasize the macro because it is so unpredictable. Instead, what we rely on is individual analysis to ensure we are in the right companies with the right attributes and paying the right price to defend against developments like this, which can knock stocks around. And on top of that, I think an important message here is that with the humility of the macro environment being so uncertain, one of the important things we do when we research stocks and put capital to work is we don't ever just work on the central case. What is the most probable thing that will happen? The reason for that is you expose yourself to the scenarios around the base case. And when you run scenarios around the base case, it's very revealing just what that could mean for how a company's share price plays out. I don't think a stock could be any more topical right now than Mineral Resources from that perspective. As great as those assets might be, they clearly have a balance sheet problem. We could now probably segue into the portfolios, and to give you a specific example of what we have been doing, we have recently sold Light & Wonder, which is a US-centric gaming company. They have a great track record, they have great assets, they have a great strategy and a strong management team. But what has changed is the operating environment. We've had some early indicators that the US is slowing. This has come before tariffs. And in addition to that, unlike their peer Aristocrat, Light & Wonder doesn't quite have the same level of earnings quality as Aristocrat. And more significantly, they have a very leveraged balance sheet. So we took the decision across our criteria that the risks are now skewing to the downside, and we sold out of that position. Should we jump across into the broader context of our portfolios, Will?
Yeah, so I think it's really important. Sorry, Steve, just to, as we stand back, our job is to provide capital preservation to enable you to be able to invest with us, so you can generate income to do what you continue to do, but the capital is reserved and it is there to benefit from the upside when it comes. We all know the charts of time in the market versus time in the market and such. But I guess our job is to ensure you that we are looking at these portfolios, managing these portfolios, not for the now, but to be there and available to benefit from the upside. But so perhaps it's worth giving a bit of talk about how we were positioned into this downturn, what's that meant for the performance of our portfolios. We are taking equity risk. We do own stocks. You can't mitigate all impacts, but
Sure.
I think it's great if we can talk about hopefully some positives around the portfolios so far this year.
Okay. Yeah, that's absolutely worth talking about. So the quick summary for everyone is, as you know, again, if I just make it as simple as calendar years, last calendar year was a challenging year for our portfolios, and it was challenging on three fronts. Firstly, we had a very concentrated year in which a lot of what we call quality at any price stocks went to the moon. Pro Medicus as an example, WiseTech as an example, Hub as an example. I mean, platform stocks featured very strongly, and we were a bit shortchanged of those names in our portfolio. In addition to that, alongside the concentration was a very strong year for the banks. The banks rose 30% alongside very anemic earnings growth, and we've been underweight that sector. And then finally, we had a few stock select issues. So in the time I've been at Climb, working alongside Will and the team, we've been continuing on to turn over rocks and do work on stocks. And broadly speaking, because we've observed quality at any price, and because we've observed now banks stumbling to continue that unsustainable performance last year, our performance versus the market has turned the corner. And what's added icing on the cake has been we've got a portion of the portfolio, not a meaningful portion, but about 8-9% of the portfolio is in cash. And so it's been very fortuitous that we've recently had this drawdown, because it's now serving up an opportunity to get involved in one of those quality growth companies with strong value creation attributes that we can now land in the portfolio at the right price. Previously, it was the wrong price, and now it's the right price. So we've been defensively positioned. I mean, we certainly have a balance of above average wealth creators and average wealth creators. In the latter camp, they are companies that we think are heavily discounted below fair prospects. So an example of that would be Ampol. Ampol's currently trading at its COVID low, and yet the business has improved. They've received government support to ensure if refiner margins collapse, they get trued up, and they bought a high-quality asset in New Zealand called Z Energy, which has bettered the business overall, given it has a very strong downstream presence in convenience retailing. So we have a balance. We have been broadly defensive. We have healthcare in the portfolio. We have gold. We have a number of real assets, and they have shown a lot of resilience and will probably benefit with the new information that rate cuts are coming sooner and possibly harder than expected. So overall, it's never good to be delivering negative returns, but I hope there's an amount of reassurance that to the extent we're largely fully invested, we are certainly not buckling to the same extent as the market, and that's showing up in our performance now.
Well, Steve, I think that's great. I guess one last piece, how are we spending our time in this downturn? How do we go about being ready to buy the companies that we really want to fill our portfolio with, that'll deliver 1, 3, 5 year really strong returns? How do we prepare ourselves to be ready to act when it hits that price?
Yeah, that's a great question. And the answer simply is everything remains the same by way of ongoing energy expenditure to research companies. I call it turning over rocks, but simply keep the energy expenditure going at all times across the universe we're looking at, Will, to frame two simple things. One is, what are the wealth creation prospects of this business? And two is, what judgment do we bring as to whether those prospects are fairly reflected in the share price? So the hope is in this major moment, which could lead to panic, we may well have a business with above average wealth creation prospects come to succumb to some sort of price insensitive selling, and that would be a great opportunity to get involved. I've always said this, and I truly believe this: good investing ideas that have duration and can make clients money are not an everyday thing. They are a once every so often thing. But obviously, given what's happening now with heightened volatility, it is starting to create, whether the word's excitement, but an amount of elevated opportunity to be getting involved. So the summary is, folks, we're not trying to get the tariff story right. We're not trying to guess what the next macro move is. We are alert to it. We have John helping us out at a high level to think about the state of the world. But what we do all the time is we review individual stocks with their individual attributes, the operating environment features, but it's never the dominant feature of how we frame wealth creation prospects. There are many companies in control of their own destiny due to the great assets, the great strategy, the great management, or the great balance sheet that they have. So that's what we're focused on. And just to lastly leave you, I mean, we did go through a handful of stocks outside the portfolio last month, and that continues on this month. So look forward to updating you again in a month's time, and we'll see where this opportunity takes us.
Great. Thank you, Steve. That was fantastic. All right. We'll see you all again soon.